Hi everyone. Let's go over some concepts in Chapter 2 that are important. Actually, we're here outside of Chapter 2 now because we're in the financial statements on page 19. I wanted to start here though because this is a good table. This happens to be Walt Disney Company, which has a big movie coming out this weekend. And basically, the reason I like this chart a lot is it has all the current assets, and by all, I don't mean every single one that exists in the world, or in the accounting world, I should say, but it has a lot of them, right? The current assets, it has the current liabilities. You have, it kind of focuses a lot on current type stuff, but the important thing is it has a nice listing of different accounts for this. And you'll notice that it has the common stock account, the retained earnings account, accumulated and other comprehensive loss. It has some of the other type accounts. Notice here too that it says common stock and additional paid-in capital. Here what they did is they took the common stock account and kind of combined it with the additional paid-in capital for those of you that are looking at when you issue above par, and they just put it into one. Sometimes you'll see this as two accounts, common stock and then below it additional paid-in capital from common stock. And here you see the treasury stock where it's deducted. 19 is not perfect. It doesn't have every single account, but it's a good place uh, to take a look at stuff. Notice too here under, I wanted to show you something here. You have current liabilities like accounts payable, accrued liabilities. That's like when you accrue interest payable, when you accrue, uh, any kind of payable that you might owe in the future. And you notice here it has total current liabilities, and then it gets into long term. Notice here that it doesn't say total, current, and long term. It says this is the long term borrowings, this is other long term liabilities. They could be notes payable, whatever. And then it just kind of blocks it up into one bucket called total liabilities. Just be flexible. You could see a balance sheet where it says current liabilities, long term liabilities, current assets, long term assets. You see here an example of the park. Again, you have total current assets, and then you have here the long-term assets. But they're not labeled long-term assets. What they've done is just put the current and the long-term and put them under one bucket of total assets. So I guess that's a long-winded way of saying is this is examples on this balance sheet of current assets. This is examples of long-term assets. This is current liabilities. These are long-term liabilities, and then you have the equity accounts at the bottom. Let's go to page 45 right quick. If you look at page 45 under your textbook, hopefully you have been reading your textbook. Let me go, I'm sorry, I have the wrong page number. It's 75. Now, in 75, we're looking at Chapter 2, Transaction Analysis. And just to review some of the stuff we've talked about, notice here again you have the golden rule of what is it that makes assets go up, what is it that makes assets go down. Notice that assets go up with the debit and assets come down with the credit. This on the right hand side, all liabilities and all stockholders equity act the exact way, the exact opposite of assets. Assets are the only ones that increase with debits and the only ones that go down with credits. When you have liabilities, liabilities do the exact opposite. Uh, they go down with debits and they go up with credits. And stockholders' equity, same way, goes down with the debit, goes up with the credit. This has to be true because all of these on the right-hand side have to equal all of these on the left-hand side. So they have to behave completely differently or you would never be in balance. Let's go down, let's see, let's go up a page. Let's go one more. Here's what I think is a really good chart because what it shows is it shows the different components. You have assets equal liabilities plus stockholders' equity. Obviously, liabilities are divided into current liabilities you owe in the next year and long-term liabilities that you owe outside of this current year. Assets on the left-hand side also has current and long-term. Stockholders' equity. What's neat about this is it breaks out and explodes the different components of stockholders' equity. Stockholders' equity, notice, goes up when you issue stock. When somebody puts money in a box and slides it towards you and you give them a common stock certificate, the stockholders' equity of the company goes up. Retained earnings come from net income. Net income, all the revenue accounts All these revenue accounts and all these expense accounts get closed out at the end of the cycle into retained earnings. Hopefully you have more of these, less of these, and you have something to put into retained earnings. If you have more expenses than revenues, you're going to start degrading and lowering retained earnings. And then dividends is just what you choose to pay shareholders. Remember that preferred stockholders get paid first, and then common stockholders get paid. If you look at one more page here as we look through this menagerie of fun, let's go to page 78 right quick. Page 78, one of the things I want to, because it's easy to get lost in just the technical jargon here. Journalizing is what you do with an accounting transaction at the very first. So you have an accounting transaction, you see what you have to do with it, and then you make an entry to the journal. The journal is also known as the Book of Original Entry. That's the first place you put an entry in the journal. It has an example down here of a journal where you received some cash and you credited common stock. This is obviously an issuance of common stock. So the first step is journalizing, right? And then let's go to the next page. And as you go down here, you will notice the idea of posting. So you enter a transaction in the journal. That does not get it into the ledger, though. The ledgers are the ones where you actually keep the numbers that you're going to use to create the financial statements. So the data has to be copied to the ledger. That process of copying the journal entries that you made, remember we're journaling? That process of taking everything from the journals into the ledgers is called posting. So you journal first, and then you post. And that's how things get into. I'm just covering this because sometimes just the semantics of what comes first and what comes second can get you into trouble. Just for purposes of this discussion, know that you journalize first in the journal and then you do posting. Just wanted to kind of review this out of chapter 2. It's been a while, sometimes since you've thought about this or looked at it. I hope you found this useful.